Hi investors, welcome to SOIC. So in this podcast, what we have done is that कि आज हम एक साइडवेज मार्केट एनवायरनमेंट में हैं। तो जनरली मार्केट में 3 ट्रेंड्स होते हैं। एक तो अप ट्रेंड होता है जिसको हम बुल मार्केट कहते हैं, एक तो डाउन ट्रेंड होता है जिसको हम बेयर मार्केट कहते हैं और एक फ्रस्ट्रेटिंग मार्केट होती है जिसको हम साइडवेज मार्केट कहते हैं। तो साइडवेज मार्केट में जनरली बहुत चॉपी मार्केट एनवायरनमेंट होता है एंड जनरली पोर्टफोलियोज मूव नहीं कर रहे होते एंड एक साइडवेज का पूरा एक ट्रेंड बना होता है। सो इन टुडेज पॉडकास्ट वी हैव विद अस मिस्टर प्रभाकर कुडवा who heads Samvidhi Capital. And Samvidhi Capital is a Cat 3 AIF, basically based out of Mangalore. And इसके अलावा सर हैज़ ऑल्सो वर्कड एट थॉमसन रॉयटर्स इन द पास्ट। तो अगर आप इनका नेम सर्च करते हैं इंटरनेट पे तो यूल फाइंड कि जो पोस्ट अर्निंग्स अनाउंसमेंट ड्रिफ्ट है या जो पीड का फिनोमेना है, दैट इज़ समथिंग दैट ही हैज़ पॉपुलराइज अमंग्स द इंडियन इन्वेस्टर्स कि जब भी एक कंपनी की अच्छी अर्निंग्स आती है तो जनरली दो स्टॉक का ट्रेंड क्या रहता है कि द स्टॉक कीप्स ड्रिफ्टिंग अपवर्ड्स। तो उसको हम पीड कहते हैं, पोस्ट अर्निंग्स अनाउंसमेंट ड्रिफ्ट। सो व्हाट इन दिस पॉडकास्ट वील बी डूइंग is that we'll be having a presentation by Mr. Prabhakar Kudwa. And in that presentation what we'll be seeing कि एक साइडवेज मार्केट या फिर जब मार्केट के रिजीम शिफ्ट होते हैं, जब हम एक बुल मार्केट से बेयर मार्केट में ट्रांजिशन करते हैं या फिर जब हम एक बुल मार्केट से साइडवेज मार्केट में ट्रांजिशन करते हैं, तो व्हाट आर द थिंग्स दैट वन नीड्स टू लुक फॉर। बिकॉज जनरली जब लास्ट 2-3 ईयर्स की लोगों ने बुल मार्केट देखी होती है तो माइंडसेट बहुत डिफरेंट होता है और जब साइडवेज मार्केट होती है तो माइंडसेट बहुत डिफरेंट होता है। तो साइडवेज मार्केट में थ्राइव कैसे करें एंड अपने आप को मेंटली प्रिपेयर कैसे करें इस पूरे के पूरे फेज को काटने के लिए, दैट इज समथिंग दैट वी विल बी लर्निंग इन दिस पॉडकास्ट। एंड मोर ओवर द पर्पज ऑफ डूइंग दिस पॉडकास्ट इज बिकॉज प्रभाकर कुडवा जी का ऑलमोस्ट 17 ईयर्स प्लस का इन्वेस्टिंग एक्सपीरियंस है। तो जितना हम लर्नेड लोगों से या एक्सपीरियंस लोगों से मार्केट्स में सीख सकते हैं उतना हम सबके लिए एज अ ट्राइब और एज अ कम्युनिटी काफ़ी अच्छा होएगा, स्पेशली जो हमारे SOIC ट्राइब है एंड साथ साथ यूट्यूब कम्युनिटी है। With this, let's start the podcast. In the starting, we'll have the presentation, then we'll have a round of question and answers.
So I have a short presentation today. So basically the topic of the presentation, as you can see, is how to navigate difficult markets. Obviously, we've been in a correction and a slightly bearish phase for the last 1 year or so. So the idea behind this presentation with SOIC is to share my thoughts with you with respect to how, what I have learned, looking at various corrections over the last couple of decades, what kind of patterns emerge from them and how best can we mitigate them, or, and what mistakes do we make and how do we kind of work around them. So that's the broad idea around this presentation. A quick disclaimer, goes without saying, right? So I am a professional fund manager. So although I don't have mentioned in the presentation itself, while discussing, if I do talk about any stock, please assume that I have a bias and do not follow any advice that you'll listen in this presentation without doing your due diligence or without consulting your own financial advisors. So this is what I intend to cover over the next maybe 20-30 minutes. So we'll look at some of the corrections that India has seen from the year 2000. तो 2000 से लेके अभी तक 25 साल में क्या करेक्शंस हुए हैं, we'll look at some examples. We'll try to understand कि इन करेक्शंस में कोई पैटर्न दिख के आता है क्या, मतलब all of these corrections will have some commonality. So what can we learn from these corrections? Let's try to go through that. Then we'll try to answer the big question, can these things be predicted? Can these things be, can you guess when there is a regime change? क्या हम guess कर सकते हैं कि bull market कब bear market बनता है और bear market कब bull market बनता है? So we'll look at least these are my thoughts around it, and this is what I have learned. So please take it with loads of salt, because I can be wrong, and I'll be happy to hear from other experts, what they think. Then we'll talk about a very important concept, which is the nature of market itself. So this is something that a lot of investors don't really pay attention to or don't really think about a lot. But it's important to understand how the nature of the market changes with the change in environment. And finally, we'll talk about 2 or 3 things, which is one is what mistakes do we make in a corrective phase or a bear market. We'll look at how can we try to mitigate these mistakes. And if you want to go one step ahead, if you want to go slightly deeper, then we can also talk about how you can thrive in these corrections, which means that how can you really take advantage of these corrections. right? So this is what I have today for you. Let's get started. So I have, put some snapshots of certain corrections, so let's go through these corrections one by one. So the first one is obviously this correction from the year 2000 to 2003. It was one of the biggest corrections that India has seen. As you can see, the markets fell. So this is a chart of the CNX 500. So I have taken CNX 500 because it represents a broader market versus a Nifty or a Sensex, which just represents the large cap. So CNX 500, the data was available in TradingView from 2000. So 2000 to 2003 was one of the big corrections. The markets fell about 61 points percentage from the top, and the correction lasted almost 3 years. Right, so it was a deep and a long correction. The next big correction that the Indian markets saw was the 2007 to 2009 correction. This was the big, the subprime crisis correction that the Indian markets saw. In this correction, the markets corrected 67% from the top, very similar to what happened, post the dot-com bust. But this was relatively shorter than the earlier correction, whereby it lasted, about 1.5, 2 years, right? But the depth of the correction was quite brutal here with 67%. Post these two large corrections, India has not really seen a very deep correction. So I'll come to, so COVID, was one correction where there was a pretty sharp fall, but it got corrected very quickly. It got corrected within a couple of months, right? So I won't categorize, that in this discussion today with respect to these snapshots. So all the other corrections that India has seen are magnitude corrections, which means that they have been long corrections, but not necessarily very deep. And the reason for this has been post 2007, the Federal Reserve, discovered this whole idea of quantitative easing. And since then, not only in India, but even in the US, we have not seen a deep correction. We've seen periods of, long sideways movement. And that is how the market chooses to punish us now. Because the moment there is a deep correction, the Fed comes into play and stabilizes the market by printing money. So that has been the story post 2007. So if you see the data before 2007, if you see the US market history, you will see a lot of deep corrections like that. 1987 in the US, even earlier, there were several corrections like that. But post 2007, the depth of the correction has gone away to a large extent. And now what we get are long corrections, of sideways markets or consolidations. So if you see this other correction from 2010 or 2011 to 2014, another 3 years where the market went nowhere. Another correction from March 15 to Feb 17, another 2 years where the market went nowhere. And then the September 18 to just before COVID, market went nowhere for about 1.5 years. So all of these were mostly sideways markets, which lasted for anywhere between 1 to 3 years. And finally, more recent data, the last sideways movement we saw was post that COVID rally we saw from October 21 to July 23, almost 2 years, the market went nowhere, right? And then the one that we are in right now, whereby the market has not gone anywhere for the last 1 year. The correction started in September last year, and we are in September 25 now. So we have to see how long this one lasts. But suffice to say that we are definitely in a sideways corrective market right now. So these are all the different corrective phases over the last 25 years. Of course, there have been other smaller corrective phases, so I have not been able to cover all of them. But I think this gives a good, big picture understanding of, what these corrections look like. So having seen, all of these examples, let's look at what patterns emerge from this, right? So what are the different commonalities that we see in these different corrections? So like I, briefly mentioned, there are two types of correction. One is a correction of magnitude and one is a correction of duration, right? So magnitude correction is a deep correction where the stock price just crashes very sharply. And a duration correction is a long period of sideways markets where investors don't make any money. So both of these corrections are pretty brutal in their own way. And very rarely you get both. Like I gave you the example of 2000 to 2003, and even to some extent 2007 to 2009-10, right? You got corrections which had both magnitude and duration. But fortunately now post the Fed era, most of the corrections are duration corrections, which means that the corrections which are lasting for a long time. So that's one thing to understand whenever you're looking at a correction, whether it's a magnitude correction or a duration correction, or is it both? The next pattern that emerges from all of these examples is that a correction is always preceded by a period of high returns or a period of bull markets. So I would go on to say that it's almost a requirement. It's a prerequisite that before you have a major correction, you should have a period where the market has rewarded you. So the market is a very fair animal, right? It rewards you and then it punishes you, right? Without a reward, very rarely will you be punished very drastically. So one of the major patterns, if you go back to those charts and see, right, all of those sideways movements were preceded by a very, very sharp rally before that, or a rewarding period before that. If you see this period here, there was a sharp rally here. If you see this period here, there was a sharp rally here, right? If you see this, obviously so there was a sharp rally here. If you go back 2007, I don't have to tell you, right? 2003 to 2007 was one of India's biggest bull markets, right? And post that big bull market, you saw, that 2007 correction, and even the dot-com, right? Before this crash happened, there was a big bull market in technology and dot-com stocks. So one of the prerequisites of a correction is a bull market preceding that. So a lot of people give an example of Japan, right, whereby they say that Japanese market has not gone anywhere for the last 20 years. But what people don't realize is that go back and check what happened before that phase started. Japan probably had one of the biggest bull market any country in the world has seen, a biggest and a longest bull market. So because there was so much money that was made in Japan before that, it went into this period of sideways for multiple decades. So anytime you worry about a correction, you have to first ask, have we gone a period of very good markets before that? If that is the case, then the correction is likely to happen. Similarly, the other side of it is that the correction is what sets the stage for the next bull market. So every period of correction, right, whether it was 2009, whether it was 2013, whether it was post-COVID, and whether it was, after the recent 2021, 22, bearish phase, the correction sets the stage for the next cycle. So it's a continuous yin and yang sort of combination of bull markets and corrections, right? It is the rhythm in which the market moves. So you have to keep this pattern in mind. And finally, the other pattern that comes out of this analysis is that the sharper the correction, the quicker is the bounce back. And we've seen that in COVID, right? The quicker the market falls and the deeper it falls, it is like a rubber band, right? So the more you pull it, it'll snap back, with a similar ferocity. And the longer the correction, the longer the next bull market. So, like I said, the biggest bull market India saw was from 2003 to 2007. But before that, the period of 2000 to 2003 was a hellish period. So, if you speak to any investors who have been around in that period, nobody was interested in the market. It was a very long 3-4 year correction. And it was also a correction which was deep and long. So, it was a very painful correction. And that painful correction gave birth to the one of the biggest bull market that India saw in the next 4 years. So the longer the correction, the longer the bull market, the sharper the correction, the quicker is going to be the bounce back. So these are some of the patterns that we can take away from our analysis of the last few corrections that India has seen. Let's focus on what leads to corrections, and whether they can be predicted. So like I already mentioned, bull markets leads to bearish phases. So the main criteria is that you need to have a very good period going on, right? If you want to predict a sharp correction or a long sideways period, then you have to be presently in a bull market, right? If you're in a bull market that is more than 2 years old, right? Now don't hold me to that number of 2 years. It's just an average number, right? It's a rule of thumb. But if you have, let's say, 2 to 3 years of back-to-back high return years, then you can be rest assured that a corrective phase is right around the corner, right? It may not exactly work like some phases, the correction may come after 4 years. Sometimes it may come after 2 years. So we don't know the exact number. Nobody knows that. But so the idea is that if you've been in a bull market for a while, then you have to start preparing for a corrective phase in the next few years. The second characteristic of bull markets are they're driven by themes. They're always driven by themes. So if 2000 was about dot-com, 2007 was about real estate and infra, 2000, the 13 to 18 was about quality and consumption stocks. And this recent one has been about defense and make in India and all of that. So you have to pay attention to the themes. So when these themes get peak media coverage, right, or they see a significant PE expansion, or they undergo an over ownership, which means that everybody is buying them, everybody has bought them, mutual funds own them, thematic schemes are being launched. These are telltale signs, right? All of these signs, and also at near the top of the bull market, what will happen is the price will not react to good news, right? And in fact, sometimes even to good news, it will react negatively, right? So the regime will change, the behavior will change. Now, all of these things do not mean that the bear market will start immediately. All of these things just point to the fact that the stage is being set, right? The bull market may end or it may not end. We don't know, but this is just setting the stage. A lot of time, what happens is this kind of an environment will be there multiple times in a long bull market, but a small correction will happen, and then after a few months, the market will go back to the new highs. So just because these conditions are there doesn't mean that a correction or a bull or a bear market will start. But these are just some prerequisites which are just setting the stage that if something goes wrong from here, right, then a deep correction or a duration bear market can start. So these are some of the pointers that you have to remember. So once this stage is set, then typically, if you look at the older crises and history, right, some event will happen which will push the market through the edge, right? So in 2000 US, there was this Barron's article called "Burning Up," right, which basically said that it basically exposed these dot-com companies, saying that they're not making any money, and they're just burning money. And at the top, I think Dell and Cisco also started doing some stake sales, which panicked the market. And that small event actually triggered this dot-com bust. Similarly, at the same time in India, the Ketan Parekh scam broke out, which kind of broke the back of the Indian bull market that was happening. 2008 was the housing crisis, the subprime crisis. 2018 was ILNFS. That was the event which triggered the market. And in the recent, what punctured the recent bull run, obviously, all said and done have been the election results, right? Whereby the ruling party did not get the full majority as was expected, and everything else then kind of slowly changed. The growth started to slow down. The capex came down, and so all of these things happened. But it was not because of these events that the bear market started. These events typically just they were just the catalyst in pushing the market off the edge, right? So the conditions are set by the bull market, by the PE expansion, by the over ownership, all the excesses that happened before that. But once these excesses are in place and you get a big negative event, that typically acts as a trigger to start the bearish phase or correction that we typically see. But having said that, so all of these things are fine. But so let's say we figure out all of these things, but is it really possible to predict consistently, when a bull market will end and when a bear market will start? The answer is definitely no. And the reason for that is every bull market has a different character and different duration, right? So every time the context changes, every time so like they say, right? So the markets, they rhyme. So it will not be exactly the same, but directionally it will be the same. But it will be very difficult for somebody to really predict and pinpoint that the regime is going to change now. Like I gave you the example, right? 2003, 2007 was one of the longest bull markets we had. And if you go back and study those 4 years, there were multiple times when the markets corrected 25-30%, and you would have felt that the bull market is over, but the markets within a few months went back and started making new highs. So it's very difficult to make that call, but how can this be used? So why are we discussing this? Now, as an investor, I think you can't really do much. Maybe you can take some risk off at the edges, right? Because a lot of times what will happen is you will see all of these things and you will cut your position. And like I said, right, it may not be the end of the bull market. Some other variable will come into play and the markets will again take off, right? But if you are a leveraged player, if you are somebody who is really dialing up the risk in a bull market, right? Or if you are, stuck in SMEs and all these kind of names where the risk is dialed up very high, then this kind of a template can be used to alert yourself that maybe, we've had a very good period. The stage is set. Any negative event can, kill my portfolio because I'm leveraged. So you can look at reducing your leverage or, making changes around the edges to cut your risk, right? So that is what you can do. but you can't predict and pinpoint that, this particular, model or this particular indicator will tell me that the market has turned. So you can just gauge the environment and reduce risk at the edges. That is what you can do. But as an investor who is not leveraged, and if you have a good asset allocation, then you just have to, live through it, right? There is no real way to predict, when a bull market will end and when a bear market will start. The next slide is probably the most important slide of, this presentation, which is basically the idea that we have to understand the nature of the market, right? A lot of people deal with markets, as if it is a machine, right? Whereby there is some formula. Every time, if a good results come, then the markets have to go up. If the bad results come, then the market has to fall. If the fundamentals are not there, then the stock price should not go up. If the fundamentals are there, only then the stock price should go up. But if you just passively sit back and watch the market on a daily basis, and and apply yourself, you will see that every day the market is screaming at you that this is not the case, right? So the market is very, very moody. The market is, the market doesn't work as per our theories, right? And I think the book Intelligent Investor, which, if you have not read, then obviously you should read that book. It's one of the best books out there, written by Benjamin Graham. He talks about the concept of Mr. Market, right? Which is basically a person who is very moody, and his mood changes depending upon the market environment, right? So essentially, what is a market? A market is a collection of humans acting in self-interest, right? So all of us, thousands of people acting is what makes the market. So if humans are emotional and humans are moody and prone to, different types of emotions, then obviously the market as a collection of those humans has to be. So even if there are algos today, right, the algos are finally scripted by humans and the risk is managed by humans, right? So the market is very, very contextual in nature. It's a very, very important concept to understand, that your analysis has to change depending upon the market context. I'll give you a couple of recent examples, right? So one which came, I think, a couple of days back, there's this company called Jupiter Wagons, right? It was into this, rail wagon and all of that. So there was a news that they did some fraud, okay? And the stock price did not budge. The stock price did not fall. In fact, it went up, I think, next day. The reason for that is, if this same stock was near 52-week highs and this news had come, the stock would have hit a lower circuit. But now that the stock is near 52-week low, there is nothing in the price, right? The context is that everything bad is already in the price. So even if such a negative news is coming, the price did not fall. In fact, it went up, right? Similarly, there is this SME stock called Bondada Engineering. So I don't know if it's still an SME, but I was just, I just watched some of these stocks, how they behave, right? So it was one of the biggest winners in the last bull market. And I think a quarter or so back, it declared fairly good numbers optically, but the cash flow was not there. I think it had some huge receivables. Now, the same receivable story was always known when the bull market also was going on, right? And the stock became a 10 bagger. And now, in a bear market, when it produces similar or better numbers, the stock hits a lower circuit. Again, it is context, right? Because the behavior of the market in a bullish phase and a bearish phase is very different. The variables that the market thinks are important in a bullish phase and bearish phase is very different. So this understanding is very important for investors, because investors act like market works on some formula. No, the market, there is no formula, right? And even if there's a formula, there are different formulas for different regimes, right? So you cannot use the same logic, or you cannot expect the same behavior from the market in different market environments. So this is something, that you have to deeply understand. You have to think about it. You have to see it, working, and you have to then apply it in your analysis and your context. Let's look at the nature of the market in a correction or a bearish phase, because that is what we are discussing. So, some of these things you would have already gone through in this phase, right? So the market is extremely irritable, right? Which means that the market, even, the good news is ignored, the bad news is immediately the market will be very volatile. When I say irritable, the market is in a very volatile phase, right? It doesn't know what is happening. The reaction to news is all very weird. Sometimes for bad news, it will go up, for good news, it will fall. So that's one behavior that we have seen, right? Second is, nothing will excite the market in a regime like this, right? Even if it excites, it will excite for a few hours or a couple of days, and then it will be back to where it started. a lot of strategies that worked in the bull market, right? Especially people doing breakouts and momentum and all of these things. These strategies will just not work in a bearish regime. And people who do not realize that pay a very, very heavy price. The regime, once the regime has changed, you have to either pull back on these type of strategies or you have to tweak them. If you're experienced, you can still continue to deploy them, but you'll have to deploy them with very different rules and very different entry and exit criteria, very different exposures, right? So people act as if I have a formula now and this formula has worked brilliantly for me in the bull market and it will continue, it will make money for me in a bear market also, but that doesn't happen. So strategies completely, stop working, especially strategies like this will completely stop working. In fact, you will lose money and whatever you have made in the bull market, you will give all of that back plus some interest, right? Reaction to earnings is subdued. We've seen that how the same reaction in a bull market, versus the same earnings in a bear market, the reactions are completely different. The best of the earnings stocks just does not move. And God forbid, if the earnings is bad, then the stock will start a very bad downtrend, which will last multiple days. The other thing is the trading volumes will disappear, especially in small caps, micro caps, SMEs. The trading volumes sometimes on a bad day, even one share will not trade. So, so anybody who is trading price action and all of that in micro caps or small caps in a bear market, when there is no volume, there is no price, then what will you trade, right? So trading volumes will disappear. Trading itself, the prices itself become meaningless because a stock will fall 10% on very small volume. Like some random HNI will sell and the stock will just crash, right? So trading volumes disappear. Small caps and the smaller companies are generally hated, right? The smaller companies will be subdued. So like I said, right, if the environment changes, then very quickly these small caps and mid caps will have a sharp rally because they are presently subdued. They have been pushed down because nobody is interested in taking any risk. And finally, this idea of this rotational tendency. So a lot of mean reversion strategies come into play. A lot of smart money deploys mean reversion strategies, and you would have seen that, right? And that is why the breakouts fail. So the moment there is a breakout, the mean reversion people will sell, and whenever there is a stock that is falling, they will buy that, and they will play that cycle continuously across different stocks and different sectors. So what we say is a sectoral rotation, right? A lot of sectoral rotation you will see happening throughout the bearish phase where money keeps moving from one sector to another sector, but net nobody is going anywhere. So overall the market will frustrate you in a very bad way if you don't understand all this. But if you understand this, if you know that this is to be expected, then I feel that that is a superpower. That is something you can use to your advantage, right? So if let's say your friend or your spouse or somebody is in a bad mood, right? You know that you have to stay away from them, right? At least for a couple of days, a couple of hours, depending upon the context. Similarly, when you know that the market is in a bad mood, that knowledge itself gives you a power that I should not overreact to this market. I should not, I know that this is not normal. The market is going through a bad phase. It is the pendulum is swinging to the other side unnecessarily. So just that knowledge that the market is prone to these mood swings, right, will help you avoid a lot of bad decisions, right? Just that knowledge. So just keep that in mind. So with that same thought, let us look at what mistakes we make if we don't understand that. If we don't understand this moody behavior of the market or this context, this bear market context, if we don't understand, and what mistakes we make, right? So one of the biggest sins that I feel investors make is reducing their exposure in a bear market or at the worst time, right? So whenever there is a negative news event, right, out of fear, if you are selling your stocks, then you just are not suited for the markets. I'll go on to say that because all of these decisions, right? See, stock market money is risk money in the sense that stock market is a volatile animal. So when I say risk money, it is not the risk of losing your money, but it is the risk that you're exposing in terms of volatility. The value of your portfolio will keep fluctuating in a pretty wild manner. So if you are prone to be panicked out of the markets, then you are bringing the wrong kind of the money. You have to bring only the money that can stay invested at the worst time, right? So that has to be your test. So reducing exposure in a bear market. When I say reducing exposure, I mean you are exiting the market or you're going into cash at the worst time, right? That is a cardinal sin. And the reason for that is when you do that, the math completely goes against you, right? I'll probably explain that in the next slide, but you just can't recover from that. You can't, it's very difficult to recover from there, right? So at least the best case you can do is just keep quiet, right? Or at least not do anything. So if you are leveraged, you don't have a choice. Like I said, if you are leveraged, then the time to act is at the beginning stage of the bear market. Like I explained earlier, you have to be open to the signs and you have to reduce your leverage. But if you are not leveraged, then the least you can do is just wait it out, have the ability to wait it out. Because if you sell at the worst point, you will not be able to recover that money because the math will completely go out of favor for you. The second mistake that people do is over analysis and hyperactivity, right? Basically, it is driven by price action, right? Obviously, you will not analyze a stock which is doing well. So all your analysis will be focused on stocks which are not doing well or in the current environment where the market is not liking those stocks. And again, you will do a similar mistake as point number one, but in a different way, whereby you will want to sell the stocks, just because they are falling, just because you can't take the pain, right? And this happens when you don't have a sense of the business, when you don't understand what exactly is happening, when you don't have proper allocation to the stocks. So you will do over analysis and hyperactivity based on price action, which is a second mistake that people do. Third mistake that people do is strategy hopping, right? Which is basically, like I said, the breakout guys at some point, they will what they will do is they will realize that this breakout thing is not working in this market. I've already lost so much money, and they will start doing mean reversion. And the moment they start doing mean reversion, the market regime will again change, right? And they will get the worst of both the strategies, right? So strategy hopping, or looking at hundreds of different types of investors. What is that guy doing? What is this guy doing? And trying to change your strategy, every 3 months. That mistake again is something that you should not do, right? You have to stick to your strategy. If you change your strategy in a bull market, you're still okay, because bull market is very forgiving, right? Even if you change something, maybe you'll make a little bit less or a little bit more in the new strategy. But in a bear market, if you change the strategy, you will be punished very, very badly, and it will be very difficult for you to recover that loss. The fourth big mistake that people make is performance measurement, right? This need to perform every year, measure the performance and take action. See, when the market environment is not good, there is no question of performance, right? There is no, see, unless you are doing something extremely bad, right? Let's say if the benchmark is down 10% and you are down 15%, or the benchmark is flat and you are down 10%, it's okay, right? Unless, there is some drastic reason for you to do performance measurement in this type of a market leads to suboptimal outcomes, because you will basically, when does the performance of a particular company or a particular portfolio, it is when the market is not in favor of that strategy, right? And so either you have to do that performance measurement at the beginning, just when the bear market is starting. But if the bear market has already played out, then it is probably high time that that strategy will start doing well again, right? Because again, everything is mean reverting, right? So measuring performance and switching funds or getting out of equity, getting into gold, all of these things are not to be done in a bearish phase, because when the recovery comes, the recovery is very, very swift. And if you have exited at the worst point, then you can't make up that difference. And finally, incorrect understanding of market caps, which means, it's the same thing, right? So in a bearish environment, small caps are the worst hit, then mid caps, and then large caps. Now, in a bearish environment, if you go and allocate to large caps, you sell your small caps and allocate to large caps, then you are doing a mistake, because you are exiting the small caps after they have taken the hit, after you have taken the pain, and getting into large caps. When the recovery comes, the small caps will go up twice the speed of the large caps, and then you will be stuck with large caps, right? So this incorrect understanding of how market caps behave in a bearish environment again leads to a lot of errors. So these are, three or four major mistakes that people do. Let's see how we can mitigate the mistake. So the first mistake that I spoke about was reducing the exposure, right? So I spoke about the math. So let's assume that you had a portfolio value of 100, and because of the correction, it came to 70. Now at 70, if you exit the market, right, you have to, and let's say the market after 6 months goes back to 100, okay, goes back to 100, and you feel that once the market stabilizes, I will re-enter. Once the market goes back to 100, you are already, you're down by 30%, which means you are behind by 50%. Because if you're fallen 33%, you have to make up 50% just to break even, right? So 100 to 70, you've come from 70 to 100. If you have to go, you have to make up 50%. And if you have not participated in that rise up, then you're already starting behind 50%. How can you ever, make it up? So selling at the worst time is something, maybe I'm repeating it at the cost of repeating it, but it is something that people have to really understand, that if you are so afraid of the markets, then you do that asset allocation at the beginning. Do that asset allocation once the market recovers. But bringing the wrong kind of money and panicking out of the markets is just not done, right? The second thing I told you about is, so what was the second point? Was about over analysis. So like I said, right, so market is manic depressive, in the words of Mr. Market, of the intelligent investor, right? So taking decisions based on price action is absolutely counterproductive. You if anything, you understand the business, and if you feel that the business itself is not doing well, or if you feel that nothing much is going to happen here over the next several quarters, then you can take an action. But just getting scared out of an individual stock based on price action is something that you will pay a heavy price, because the moment the environment changes or that overhang which is there goes away, right, the stocks will see a sharp rally. So I can give you an example, right? So a lot of tariff related stocks were beaten down up until last week. Now, the moment the news that Trump is maybe turning around, or the stance is changing, you saw a lot of those stocks go up 15-20% in a matter of 1 or 2 days, right? Now, and I'm sure you will not enter them even now, right? Because still things are not 100% clear. By the time things are 100% clear, the stock prices would have gone up 50% from your sale price. That is the reality of the market, which is why I say that purely based on price action, you should not act, or you should not take decisions of exiting any stocks in your portfolio. Third thing I already spoke about, if you hop strategies, then you will get the worst of each strategy. So what you have to do is you have to stick to one strategy for the full cycle and evaluate how that strategy has done. And then after the cycle, you can analyze whether you want to continue it or not, don't continue it. All those things you have to do once the market recovers and stabilizes, at least to some extent. If throughout the correction you keep jumping from one strategy to other strategy, you will get the worst of each strategy. And finally, like I said, performance measurement, right? So returns in the markets are lumpy. So whether we like it or not like it, the market is not bothered. So there will be times when I have so many examples where markets will go nowhere for 1.5, 2 years, 2.5 years, and suddenly the next 2-3 years the market will give you several multi-baggers, and it will make up for all of those difficult periods. So like I said earlier, right, the market is very fair. If the market has punished you, then the market will definitely reward you. And if the market has rewarded you, then the market will definitely punish you. So this cycle of reward and punishment continues. The idea here is that performance measurement in the market has to be done over cycles and not over years. This idea of looking at 1 year return every year or quarterly return is going to be counterproductive to you, whether we like it or not, right? So a lot of people who entered the markets 3-4 years back are happy because their 3-4 year CAGRs are very good. They are 20, 25, 30, 35% CAGRs. But the people who entered the market last year are already complaining. But what they have to understand is that this is not a 1 year game. This is a 5 year game, right? So if you entered the market, you enter with that 5 year outlook and evaluate your returns over that period, because you don't know how what permutation combination will play out in these 5 years, right? We may have, first 1.5, 2 years can be bad, and the next 3 years can be a crazy bull market. Who knows, right? So if you are evaluating every year, you are prone to making mistakes in decision making. And finally, the order of priority, like I said, right? In a bearish phase, small caps are the most neglected, and that is where they provide the maximum opportunity, and then mid caps, and then large caps. There is this idea that during difficult market, you should hide in large caps. You can hide in large caps as a risk management exercise, but if you're getting out of small caps and going into large caps at the in the throes of a bear market, then again you are doing yourself a lot of injustice. Finally, if, so there are people who make mistakes. Now we've spoken about how you should avoid those mistakes. But now let's say if you want to go one more step and you want to take advantage of these corrections, then how can you do it? So let's look at 4 or 5 points around that. So one is deploy incremental exposure if you can. There is nothing like investing money in a correction. So I recently also made a tweet whereby I spoke about this, that the alpha that you will generate merely by putting money during a difficult market is much higher than any stock picking strategy, right? So just the ability, if you can, any amount, small amounts, and that is why SIPs work, right? If you ever thought about why SIPs work, and let's say you are with a PMS or an AIF or any of these guys, they don't have the advantage of an SIP, which means that during a difficult market, very few investors will put incremental money at, in the throes of a correction, right? But an SIP, what happens, automatically money keeps going during the bad times. And if you do if you break up the return profile of an SIP, then you will see that most of that alpha has come because you have invested every month during the difficult times, because you invested in the COVID months, because you invested in the in that correction period where the market went nowhere, because you kept accumulating the units during the bad periods, you make that alpha. That is why SIPs work. SIPs don't work because you're disciplined and you're regular. SIPs work because the markets are volatile and they automatically make you invest during times when most other investors don't. So incrementally deploying exposure is one of the ways you can go to the next step and take advantage of a correction. Intelligent switching, right? Even switching has to be done. If you feel that there is a business you always wanted to buy, but it was expensive and now it has corrected, and you feel there is an opportunity, then you can definitely switch, because you are not getting out of the market. You are switching from a business that is you feel is inferior into a business you feel is superior. Again, you're not going by the price action, but this correction is giving you an opportunity to get into a better business. And even this activity I've seen, and I've taken these hits and I've learned these lessons, that you have to do it once the volatility subsides, right? On the day of the bad news, or when the market is falling like a knife, if you do these switches, you will lose in that volatility. You have to allow the market to fall, and typically there will be a bounce back up and the market will stabilize. Of course, the entire fall will not be recovered, but let's say the market has fallen 100 points and then it recovers, let's say 60 points, right? And then it goes into a sideways movement. That is when you have to look at this intelligent switching. Third is, as far as your strategy is concerned, corrections are a very big learning opportunity. It's a live learning opportunity. No reading in the book can give you the clarity and the context that a live correction can give you. So this is a great period for anybody who has a strategy to build clarity around your strategy, figure out how is my strategy performing in this difficult phase, tweak it at the edges, try to improve the returns, stick to your strategy, but try to filter it, try to refine it, try to tweak it at the edges, so that when the next correction comes, you are in a much better position. You will, of course, lose money. There is no strategy that will work the best in a bear market and a bull market both. So you will have to have a compromise. So if you have a strategy for bull markets, then in a bear market, you have to see what best can you do around the edges to mitigate your drawdowns, or try to do something within the same strategy which can improve your overall experience in that period, right? You will still lose money, you will still have a drawdown, maybe you can reduce the drawdown a bit. So those are the things that you have to think about and reflect and implement during these corrective phases. And finally, about the performance, you have to develop the mindset that you will not bother about making money every year. If you study any investor, the best of the investors, whether in India or abroad, everybody goes through the same drawdowns that we go through. Everybody goes through multiple years where they make no returns. You've listened to so many interviews on YouTube, you've read so many books. Just reflect on this point. Everybody goes through, when the market environment is not good, nobody can make money no matter who is, right? So the difference is the mindset that I am playing a cycle. I am playing the long-term game. I am playing. So this is the year for me to invest. This is not the year for me to harvest. This is the year for me to do the things which will give me the result 2, 3 years down the line. So that kind of a mindset is required. Every quarter, every month, every year, if you sit and analyze how much have I made, I would have been better off in gold. I would have been better off in FD. It's not going to cut it. And finally, priority. If you can, right? If you are that next level investor, then like I said earlier, right? the best performers out of a correction are always small caps, right? If you are deploying that incremental money, then it's a risky thing to do. So maybe you have to spread it out, but getting some small and mid cap exposure in corrections, gives you outsized returns because small and mid caps are beaten down extra in a correction. The large cap has fallen 10%, these would have fallen 20-25%. So there is the pendulum swings more to the extreme for these guys. So if you are deploying that extra money, and if you feel that you have that risk appetite, right, and you want to go to the next level, then you have to allocate a significant part of that incremental money to small and mid caps, because when the market turns, you will make the maximum money there. And actually the risk is lowest at this point, in these small and mid caps relative to the return, right? Relative to the return, the risk is the lowest. So that is what I would say. And I think if you have any questions, you can always reach out to me at my Substack, Twitter, YouTube. Happy to answer any questions. Back to you, Vishmohit.
Perfect, sir. I think that gave, all of us a lot of clarity on how to go about dealing with the sideways markets, and it gave us a very good perspective also. So I think what we'll do, sir, that we'll have a round of Q&A, and I just have a couple of questions prepared after like talking to the audience also. So just a question, I think, as I saw in the presentation also, I think a lot of times people get frustrated ki, if someone is doing PEED, for example. I think something that you've basically spoken about in the past also, and one of the very interesting frameworks that you've discussed is that तो ऐसे मार्केट में कभी कभी पीड भी चलना बंद हो जाता है. Instead of post earnings announcement drift, it leads to post earnings announcement dump. And this is a funny thing that I say internally. So how to go about having that mindset कि यार अभी regime change हो गया है, maybe I should stick to my style, but it is totally okay कि मेरे को मंथ ऑन मंथ मैचेस नहीं खेलने, डेली मैचेस नहीं खेलने. तो हाउ टू थिंक अबाउट दैट एज एन इन्वेस्टर?
या मतलब पहली चीज तो यही है कि जैसे आपने बोला कि वो अंडरस्टैंडिंग की रिजाइम चेंज हो गया है, क्योंकि एक मतलब वो प्राइस का रिएक्शन आपको ऑब्जर्व करना है. मतलब बुल मार्केट में तो हमने सबने देखा ही है, तो डायरेक्ट गैप अप होता है और उसके बाद चांस ही नहीं मिलता है. तो
करेक्ट.
वहां पे हमारा कंप्लेंट ये होता है कि अरे इतनी जल्दी भाग गया करके. यहाँ पे इट इज द अदर साइड ऑफ द कर्व कि यहाँ पे मतलब भाग ही नहीं रहा है, मतलब चाहे जितना अच्छा रिजल्ट आए, कुछ भी
करेक्ट.
आए. बट इसमें दो टाइप ऑफ केस स्टडीज मैंने देखे हैं. अगर जेन्युइनली अगर रिजल्ट बहुत अच्छा है, तो इवन बैड मार्केट्स में भी मतलब उतना नहीं जाता जितना बुल मार्केट में जाता है, बट अपॉर्चुनिटी होता है, राइट? अनलेस मतलब कोई बहुत बुरा जियोपॉलिटिकल न्यूज चल रहा हो उस हफ्ते, या ऐसा कुछ हुआ, तो शायद उस हफ्ते नहीं वो जाएगा, बट उसके बाद वो जाएगा. सो वन ऑफ द थिंग्स वी कैन डू इज दैट वी हैव टू फोकस ऑन न्यूअर आइडियाज. बिकॉज क्या होता है ना कि बुल मार्केट के जो ओल्डर आइडियाज होते हैं उसमें काफी लोग स्टक होते हैं.
करेक्ट.
और अगर जैसे अगर आपने पीड कोई आपने लिया है, लेट्स से आपने लास्ट बुल मार्केट में लिया है, मतलब बुल मार्केट जब चल रहा था आपने लिया, तो Q3 में आपने लिया, जब जैसे ही Q4 आया तो बेयर मार्केट स्टार्ट हो गया, ठीक है, और आपको लगता है कि रिजल्ट अच्छा है, बट स्टॉक बिकॉज ऑफ द बेयर मार्केट ऑलरेडी 20-25% गिर चुका है, बट रिजल्ट अच्छा है तो आप उसमें बैठ जाते हैं. फिर Q1 भी आता है, ठीक ठाक आता है, बट उसमें क्या होता है ना कि द मार्केट वुड हैव मूव्ड ऑन टू न्यू स्टॉक्स, राइट?
हम्म.
वो स्टॉक में अभी ओवरहेड सप्लाई रहेगा, उसमें काफी लोग स्टक हैं उसमें, सो वो स्टॉक्स चलने बंद हो जाते हैं. और नए जो स्टॉक है ना, जो लास्ट बुल मार्केट में पार्टिसिपेट नहीं किया है, या अभी आप देखोगे रिसेंट आईपीओज होंगे, सो दोज काइंड ऑफ स्टॉक्स में अगर पीड आता है, तो सम पार्ट ऑफ द एलोकेशन शुड गो देयर, बिकॉज उस स्टॉक में ओवरहैंग नहीं है,
राइट.
एंड दे विल बी द दे विल बी इजिएस्ट टू टेक ऑफ. तो ये एक छोटा सा सटल पॉइंट है कि द विनर्स ऑफ द लास्ट बुल मार्केट आपके पोर्टफोलियो में कितने हैं और नए स्टॉक्स आपके पोर्टफोलियो में कितने हैं. सो दैट ट्रांजिशन इज समथिंग दैट वन हैज टू स्लोली मेक. ऑफ कोर्स एक्सेप्शंस रहेंगे, क्योंकि पुराने बुल मार्केट के स्टॉक और भी चल सकते हैं, ऐसा नहीं है कि वो
हम्म.
चलेंगे. बट इन अ डिफिकल्ट मार्केट होता क्या है कि वो पुराने बुल मार्केट के स्टॉक्स ओवर ओन्ड हो चुके होते हैं, right? जिस जिसको लेना है वो सब ले चुका है, वो अब वो अच्छा रिजल्ट भी देगा, तो उसमें उतना जोश नहीं रहता है. बट
राइट.
नए स्टॉक में थोड़ा बहुत आपको अपॉर्चुनिटीज ज्यादा मिल सकता है.
Hmm. Hmm. I think, sir, what we have also seen is that once a particular factor has gone through a multiple re-rating also, then it takes some time for the जो basic returns का digestion होता है, it takes some time also for that to happen, right?
Correct. It is about it is again about the same thing, right? See, PED is a structural tendency, so in the sense that अभी जैसे मोमेंटम इज ऑल्सो अ स्ट्रक्चरल टेंडेंसी, बट मोमेंटम में क्या होता है कि मोमेंटम इज सेल्फ डिफीटिंग आफ्टर अ पॉइंट. तो
हम्म.
मोमेंटम मतलब ट्रीज कांट ग्रो टू स्काई बोलते हैं ना, कि मतलब कितना ऊपर जाएगा तो घूमना ही है. जैसे जैसे ऊपर जाता जा रहा है उसका वेट बढ़ता जा रहा है,
राइट.
और इट विल फॉल ऑन इट्स ओन वेट. सो मोमेंटम में वो प्रॉब्लम आता है, एंड दैट इज वाई मोमेंटम बुल मार्केट में चलता है और बेयर मार्केट में पूरा का पूरा रिटर्न वो निकाल देता है. बट पीड में क्या होता है कि पीड इज मोर स्ट्रक्चरल इन द सेंस दैट कि अर्निंग्स, बिकॉज अर्निंग्स ड्रिवन है. तो
करेक्ट.
तो वही मैं बोल रहा हूँ आपको कि अर्निंग्स, इट इज पीड इज नॉट ओनली अर्निंग्स. लोगों को लगता है सिर्फ अर्निंग्स है. इट इज अर्निंग्स, अंडर ओनरशिप एंड नेग्लेक्ट. अगर अर्निंग्स विद ओवर ओनरशिप आ रहा है विच हैपेंस टुवर्ड्स द एंड ऑफ द बुल मार्केट, तो वो एक्चुअली पीड नहीं है. मतलब द वे, एटलीस्ट द वे आई लुक एट इट, पीड इज पीड इन द सेंस ऑफ द अर्निंग्स एनालिसिस, इट इज पीड. बट ओनली पीड विल नॉट वर्क. You have to have पीड plus neglect plus under ownership, and that is what gives the fuel for the stock to go up.
राइट.
So ये एक aspect people have to understand.
I think, sir, you make a very important point there because the way people have been looking at PEED over social media, they ignore the surprise, the under ownership, and the beating of the expectation part. I think a lot
Correct,
of times.
correct, correct,
सर एक फॉलो अप क्वेश्चन इसी से था सर कि आई थिंक यू राइटली मेंशन कि आपको पोर्टफोलियो का फ्रेशनेस इंडेक्स भी देखना
correct,
चाहिए एज एंड व्हेन यू गो थ्रू डिफरेंट
correct,
मार्केट साइकिल्स.
correct,
बिकॉज टिपिकली वी हैव सीन कि कंपनीज का पर्पल पैच आता है 4 to 8 क्वार्टर्स का.
correct,
देन फिर बेस इतना बड़ा हो जाता है. अगर कोई मैन्युफैक्चरिंग कंपनी अगर न्यू केपेक्स भी अनाउंस करती है सो 2-3 साल तो नॉर्मल है एक प्लांट को आने के लिए इफ इट्स अ ग्रीन फील्ड प्रोजेक्ट.
correct.
तो how important is the idea of maintaining different factors plus the idea of maintaining portfolio freshness? Because suppose अगर मैंने लास्ट बुल मार्केट में रेलवे स्टॉक्स में था और अगर मैं आज भी रेलवे स्टॉक्स में बैठा हूँ मे बी एक कवच की स्टोरी एक स्प्रिंग की स्टोरी छोड़ के बाकी मतलब जो बेसिकली फैक्टर था रेलवे स्टॉक्स का दैट हैज गॉन थ्रू हाइबरनेशन टाइप पीरियड ओवर द लास्ट 18-24 months और बिकॉज ऑफ एन नंबर ऑफ रीजंस की बजट कट हो गया कुछ भी हो गया. तो how important do you think is to maintain the portfolio freshness and to keep doing sectoral rotation as and when you see the valuations have basically become very high and now also the idea कि मेरे को लगता है valuation में जो sentiment हम कहते हैं that comes because of over ownership because now everyone is talking about it.
Correct.
How important do you think is this idea, sir?
No, it is very important, but we have to see, we have to think of it as one cycle. We have to play it for a cycle. And once we understand that that cycle is over or that cycle is fully priced in, that is when you have to go to the next set of ideas. So why I am talking about that now is because I feel that whatever did well in the last cycle, right? So that cycle, I think more or less has played out. Now we are entering, probably will enter a new cycle, a new bull market may resume, sometime in the next 6 months. We don't know when it will, when it will start, but timing of, changing that freshness is important, right? अगर आप हर क्वार्टर freshness करने जाओगे, then you will not be able to make money because you will keep switching out of stocks unnecessarily. So I'll give you an example, right? So Masdoc was something that I saw back in 21, I think, and there were a couple of quarters where the results were not great. So the regular paid guy will say कि result अच्छा नहीं है, निकालो किसी और, go into a new idea or a fresh idea, right? But because the theme was intact, right, and you think in terms of the cycle, I persisted with it, and obviously the stock did phenomenally well in spite of not so great results. But the results came later. But there will be these purple patches in the middle of a cycle. So there is a difference between a purple patch in the middle of the cycle and the purple patch at the end of the cycle. So that
Hmm.
is why I spoke about in the presentation about the idea of context. So context is very important. Any concept, any theory has to be understood in the right context. So where are we on the curve, right? So अभी अगर आप फ्रेशनेस की बात कर रहे हो, इट मेक्स अ लॉट ऑफ सेंस बिकॉज दैट साइकिल हैज प्लेड आउट. पी एक्सपांशंस हो गए इन सब में, लॉट ऑफ ओवर ओनरशिप हो गया है. बट when this new cycle starts, right, every quarter, if you are trying to change, jump from one peed to the other peed, then your results will be suboptimal.
Right. I think, sir, as rightly when we were having a conversation before the presentation, also you rightly mentioned. I briefly remember कि आप technicals use कर सकते हो stocks को screen करने के लिए. But a lot of times holding में in a choppy market technicals will chop you out completely. And
Correct.
even if the theme is good and what happens is that कि फिर then एकदम मतलब if the कोई भी कैटलिस्ट प्ले आउट होता है अर्निंग्स आ जाती है उस बिजनेस में या न्यूज आ जाती है सेक्टर के फेवर में तो लॉट ऑफ टाइम्स व्हाट हैपेंस कि प्राइस एंकर हो जाता है कि यार ये तो मैंने सस्ते पे लिया था अभी चॉप आउट हो गया देन इट बेसिकली गोज अप 30-40-50% एटसेट्रा एटसेट्रा.
Correct.
तो टेक्निकल्स का सर इम्पोर्टेंस जो फंडामेंटल इन्वेस्टर्स टेक्निकल्स को ज़्यादा मिक्स करते हैं Where do you think it is the most important, whether it's on the entry side, screening side, or exit side? So how do you think about this, sir?
Yeah, so I use price action. Price action is important because price action is a very good scan, right? Nobody is so good that they can identify all of the opportunities that are out there in the market. So in that sense, the price action gives you a shortcut, so to speak, कि कहाँ पे action हो रहा है, right? So and I've spoken earlier about this idea of a young momentum, right?
Mhm.
So you have to look for young momentum. जहाँ पे momentum recent है, you have to use that as a scan. Let's say 1 month data, 3 month data. You look at that for ideas कि यहाँ पे क्या हो रहा है, यहाँ पे क्या हो सकता है, right? Is any theme emerging here and stuff like that, right? So having said that, price action for deciding, when to sell is basically, something that I have tried and miserably failed, as I'm sure many people have, right? Because price action is very fickle, right? Like I said, I spoke about how moody the market can get, right? So the price is a reflection of the market's moods, right? So any small corrective phase in a bull market, and a bull market will see many corrective phases. Any small corrective phases for a price action guy, the market will throw you out of the position at the worst time. So using price action for anything beyond scanning, at least for people like us who are investors, right? It will not work. So it will, you can use price action for two things. You can use price action whenever there are euphoric rises, you can sell into strength, right? That is one thing you can use price action for. And the second thing, like I said, is you can use price action for scanning, right? You can use price action to find out what might be the new ideas which are emerging in the market. But anything to do with using moving averages or this or that if it comes below this, I will sell. All of those things are fraught with the risk of you missing out on a big winner, which I am sure a lot of people will attest to, whoever have done this.
Right, right. I think I remember correctly. I think एक बारी अपार इंडस्ट्रीज का ब्रेकडाउन आया था 2700 से 2300 तक का. A lot
Correct.
of people got chopped out, and then it
Even,
started a new
even now,
rally.
even from now, 10,000 had come all the way to, I think, 4,000 or 5,000, right? And once again, it is back.
Right,
So,
right,
so if you have to use price action, you have to use it to, that's what the problem with momentum is. That the problem with momentum is you have to enter on momentum and exit while the momentum is intact. The
right,
mistake people do is they exit when the momentum is over. By that time, I mean, you've lost 60% of what you've made.
right, right. I think so. जब भी regime shift होता है, a lot of times these mistakes tend to also happen.
Correct. Correct.
एक सर मतलब आई थिंक जस्ट 2-3 more questions. आई थिंक सर जब ये whenever the regime changes also what happens is that investors who are typically very good at a particular style or two or three styles, they tend to start doing style drift.
Correct.
For example, जैसे सर 2018-19 में suppose if I was buying companies which were market leaders, small caps, but the stocks weren't moving even in spite of 20, 25, 30% PAT growth. So I had to make peace with 12 to 14 months of no returns, right?
Correct.
And then at the same time, I see there is a factor in large caps, जहाँ पे मतलब paints companies at 100p, like underwear companies at 80, 90p, and those type of businesses which are delivering 10, 15% type PAT growth are still moving, but the companies that you own are delivering 25, 30% PAT growth, but the stocks aren't moving. So how important do you think, sir, it is to stick to your style, but at the same time be flexible enough with your process? कि मे बी उस स्टाइल के अंदर हमने डिफरेंट टाइप का बिजनेस ढूंढ लिया, बट अगर आप कंप्लीटली इस सिनेरियो में सर चेंज कर जाते हैं तो डू यू थिंक सर व्हाट कुड बी द प्रोज एंड कॉन्स ऑफ दिस?
No, that was one of the reasons which made me graduate towards speed, right?
Yeah.
That it kind of, you are aligned with the market, right? You are basically chasing where the growth tailwinds are, right? Basically aligning your portfolio to the current growth tailwind. And that is why, I kind of gravitated towards that because in a way, it is a bit of an all seasons thing. Of course, the returns are not all seasons, but the strategy itself you can take your portfolio to wherever the factor is working, so to speak, right? But if that is not the case, and if you have some different strategy, right, then I think there is no answer, like in the sense that there is no running away from the fact that a strategy will underperform, right? So for example, I have been underperforming in the last 1 year after having a very good 3, 4 years, right? We have been underperforming because I have been so I'm typically, I feel that the alpha in the markets is made in the small and mid caps. right?
Right.
Over a cycle, right? So this period, like I explained, has been brutal for small and mid caps, right? So I have to be okay to underperform, right? That's part of the game. But you have to keep that, that vision intact, right? Like I said, right? The measurement period cannot be every year or every quarter. The measurement period has to be the cycle. You have to think in terms of the cycle. So I am now thinking of my portfolio in terms of the next cycle. So I
Right.
am more worried about how am I going to position my portfolio for the next, let's say, 3 years, right? I am not worried about the fact that I have not made money for the last 1 year because I have done phenomenally well if I take a 4 year view or a 3 year view, right? So the idea is to do that. So look at your, not don't look at your 1 year CAGR, you look at your 3 year CAGR or a 4 year CAGR and focus on that number and plan for the next 3 years.
Right.
That is how you survive that depressing phase.
Right, right. Because I think these days on this is the age of social media. We also see some of the posts on Twitter. That recently, like some one of my friends, I think they launched a mutual fund scheme. अभी एक महीना भी नहीं हुआ मतलब, and people are saying the fund has not given 1% return. Like, it's crazy type of environment with people. What type of posts they write?
No, because people don't. That was one of the points I made, right? People see a lot of people have gotten into the markets in the last 3, 4 years, and a big majority, I think, has come in the last 1 year, right? After
Yeah.
whole euphoria and the FOMO, right? So they don't understand how this game works, right? And that is where I think you are playing a big role in terms of educating and all of that. But I think your focus is a lot around the educating around the businesses, but educating around how the markets, really work is also, is a big area. Because like I explained, right, there is no point in measuring performance in this environment, right? Unless you have done something drastically bad, right?
Right.
This is an environment where you have to just be happy to survive. And this is a period of, planting the seeds, so to speak, right? This is not for harvest. So the harvest will come. So that understanding people don't have, people compare it with, if I had not done this, if I had put in gold, I was better off. So they're now coming to a conclusion that gold is better than equities. Now they're
Right.
talking about the returns of gold are equivalent to Nifty returns. So all those things people have to really understand that one is that market is not Nifty and Sensex, right? And looking at the, one comparing one asset at its best time and one asset's worst time is just not the right mathematics to do.
Right. Right. I think that you have basically beautifully put, because recency bias is something that is very common in investors.
Yes.
Uh, and sir, just to last two questions, sir, because this is something which I also face a personal challenge sometimes. Ki got into a story where the theme is good, valuations are decent, growth triggers hai, the promoter is also good. Then there are these lull phases which tend to happen. तो अब lull phases में सर कि how do you basically deal with those lull phases, because sometimes you also tend to question yourself कि whether my thesis is correct or not, even though you have a diversified portfolio, some stocks will be working, some won't. Well, it's impossible for 100% of the stocks to work at all the times, but how to deal with that lull phase, any mental model or thought process that you have with it?
Yeah, so two things, right? So one, like I said, that I focus on the quarterly results. So quarterly, so 3 महीना तो wait कर ही सकते हैं ना. तीन
Correct.
महीने में लल अगर आ गया तो चलेगा.
नहीं नहीं
So
सर, जैसे आपका आपने स्टोरी बताया मजगांव डॉकयार्ड का सर,
हाँ
उसमें
हाँ.
5-6 क्वार्टर का लल फेज भी था सर बीच में.
So that's what I'm coming to that. So either it is, one variable is the earnings and one variable is a thematic tailwind, right? So if these two are there, then I am willing to give it a chance. अगर
हम्म.
वो मैचडाउन डॉक नहीं होता और कोई और कंपनी होता तो according to my strategy or my framework, I would have exited after a couple of quarters and taken whatever good or bad. उसके बाद ऊपर गया तो गया. But I have these two variables, right? So I have the quarterly results. So the results have to, at least year on year, they have to show some growth, right? So if not quarter on quarter, that at least year on year, there has to be meaningful growth, and there has to be a thematic tailwind that tells me that the growth is coming in the next few quarters. And this is where having a bit of a diversified portfolio also helps, because आपके portfolio में कुछ ना कुछ चलता रहेगा, so you will be entertained in the sense that कि आपको, it will allow you to sit with a mass doc because an APAR at that time is doing well, or a PGL is doing well, or something else is doing well. So, if your portfolio, like at least I run a portfolio of about 30 odd stocks, right? So,
हम्म.
so you will always have 20-25% of the stocks which are going through the lull. And you have another 25-30% which are doing extremely well. that portion that is doing extremely well keeps pulling up your returns to some extent and keeps you in a mentally, much better place. But वही concentrated investor अगर रहेगा ना, उसके बाद let's say only 5-6 names are there, they have to deal with this psychology of being not being in the throes of action, right? Because there will be periods where आपके stocks नहीं चल रहे हैं, right?
Hmm.
At that point in time, you have to just wait. I mean, because that is what you have chosen, and
Right.
because you have chosen that, it means that you have the fortitude to wait. Because if you don't have the fortitude, then change yourself from concentrated to diversified so that you always have something to cheer yourself up.
Correct. Correct. I think वो डेली लोगों को एंटरटेनमेंट लगा रहता है, so then they also feel happy also.
Yeah, I mean, the other extreme of that is people who have 100 stocks and all that. I mean,
Yeah.
so
Yeah.
they are always entertained, right? So they, even in the worst day, they will have a stock which is gone up 20%, वो Twitter पे डाल देंगे. But I'm saying we have to come to, if you come to a middle point, right? Let's say
Right.
25 stocks, 30 stocks, then often I have seen that some segment of the portfolio will do well and some segment may be in a lull. So that what is doing well allows you to not disturb that Mazgao dog and allow it to do its job, right? So it's also a psychological hedge, so to speak, having a bit diversification.
I tend to think of it as ki there are different horses which are pulling the chariot.
Absolutely.
Sometimes some horses will run fast, some horses won't work, but the chariot
Absolutely.
has to move over
Has
like
to move
everybody
forward.
else.
Absolutely. Absolutely. Perfectly put.
Right. So just a last question. I think because we also track some of the macro news and stuff. So last 3-4 years, the cycle was investment led cycle where we see the government capex had a big kicker in terms of the मतलब अगर आपका capex 3-4 लाख करोड़ का था वो एंड में 11-12 लाख करोड़ का हो गया गवर्नमेंट का. So now we are seeing a lot of things which are happening is that there is an income tax cut, there is a GST cut also now happening, and also easing of liquidity cycle by the RBI. Government का मैं पीछे देख रहा था, they are asking the public sector banks to lend at a faster pace, right?
Correct.
So do you think even in broad macros, just thematically, how are you thinking? And in even terms of broad macros, will we see could we see a regime shift from investment-led stocks to more of consumption-led stocks? How are you thinking about this, sir? And some of the themes that you think could be interesting over the next 3-4 years.
No, I mean, obviously, I've not come to a conclusion around this. And because, like I said, right, I feel that we are probably at the beginning of the next leg, right? Or,
Hmm.
or maybe we are beginning to enter that next leg over the next, 1 year or so. So I think my strategy always has been to not anticipate, right? So my strategy always has been to allow the quarterly results or these price scans to tell me where the action is, because the moment you anticipate, right, you go into a different frame of mind. Then you आपने अपना दिमाग मतलब बना लिया है कि ये थीम चलेगा, it becomes very difficult for you to pivot or तो मैं I want to keep an open mind, right? I don't even want to, I mean, to be frank, I don't even want to think about it कि बे अगला कौन सा थीम चलेगा, because that binds you down, that pulls you. अभी अगर आपको लग रहा है नहीं इन्वेस्टमेंट का चलेगा अभी इतना, अभी गवर्नमेंट कैपेक्स और भी स्पेंड करेगा, ये करेगा वो, या कंजम्पशन, राइट? बिकॉज कंजम्पशन इज द बजवर्ड राइट नाउ कि जीएसटी आ गया तो ऑब्वियसली कंजम्पशन चलेगा, राइट? इट मींस दैट, बट दोस थॉट्स, राइट, दे विल काइंड ऑफ बॉक्स यू, and
Hmm.
I don't want to be boxed. And that has been my strength. The reason why I could get into a Matchdog or a PGL or or some of the shady names also, which I keep saying, right, like a Shakti Pumps or some of these names, I was able to participate because I had an open mind.
Right.
And any thoughts right now about what themes will do well will be, counter to that sort of a mindset.
Correct. Correct.
That mindset has been my strength, that ability to stay open and कि देखेंगे क्या होगा, let's see what comes up, let's track the results. That track, जो अपने आप tailwinds सामने आएंगे ना, the tailwinds will come,
Hmm.
the market will show its hand. Why do you want to, when the market has the habit of showing its hand, then why do you want to play blind?
Right, right, right. I think, sir, this was also another being open-minded is also, I think, extremely important. I think, sir, question I think sir, कहाँ से आया था, जैसे consumption का जैसे बात हुआ तो I think auto anks or auto would be like one of the sectors which could be the अगर क्या टैक्स कट होता है जैसे जीएसटी कट हुआ तो वहाँ पे डिमांड काफी तेजी से मतलब बढ़ सकती है which I think price action wise also market has sort of started indicating I think.
Correct. No, it is one of the, definitely one of the potential sectors. काफी consolidation भी हो रहा है auto ancillaries में. If you see names like Gabriel and what they have done and all of that, so काफी consolidation हो रहा है. So auto ancillaries is definitely on my radar. Autos is definitely on my radar. But I was making a slightly,
Correct,
taking a
correct.
step back and making a bigger point. कि वी हैव टू बी ओपन माइंडेड कि शायद ये नहीं भी चले.
करेक्ट, पॉसिबल.
ऐसा कुछ नहीं है ना कि मतलब बिकॉज एवरीबडी इज टॉकिंग अबाउट इट, इट्स ऑल द मोर रीजन व्हाई यू हैव टू बी अ बिट मोर केयरफुल, क्योंकि एवरीबडी इज टॉकिंग अबाउट कंजम्पशन एंड ऑटोज, राइट? सो मार्केट हैज आल्सो प्राइस्ड इन, इफ यू सॉ द प्राइस एक्शन आल्सो.
हम्म.
जीएसटी का जब कट अनाउंस हुआ उसके बाद से these stocks have come off. They started going up when the prime minister announced it on 15th August. तो
राइट.
प्राइस इन बहुत जल्दी हो जाता है आजकल बिकॉज ऑफ सोशल मीडिया एंड ऑल दैट, राइट? द डिसेमिनेशन ऑफ इंफॉर्मेशन इज सो फास्ट दैट थिंग्स गेट प्राइस्ड इन वेरी फास्ट. पहले देयर वाज अ लॉट ऑफ टाइम टू मेक मनी. Now pricing in also has become very fast. So you have to see it in that context कि अगर price in हो गया और उतना anticipated growth नहीं आया, then you're stuck, right? So that is what. So it's still on the radar, but keep a watch and keep an open mind. And I'm sure the biggest winners will come from things we are not even thinking about.
राइट. राइट.
You go back to any bull market and you see, right? I mean, most of us will not have the context, but at the beginning of the bull market, it never looks like कि ये मतलब वो बनने के बाद पता चलता है कि अच्छा ये थीम है. It's all in hindsight. It's all rationalization that happens later. So you have to, let's see. I think the market has not yet played its hand. So a lot of themes will emerge. So I think we should keep an open mind, and I think if we keep watching you also, I think a lot of your con call analysis, a lot of answers are hidden there, right?
वी ट्राई आवर बेस्ट इस पे तो.
Yeah, a lot of answers are hidden there. So absolutely.
It's a lovely hosting you, sir. I thoroughly learned a lot. I also took a lot of bunch of notes also, and I think hopefully we do another podcast sometime, maybe next 3 to 6 months, when we maybe the market starts showing its hand, and then we can also discuss a lot of themes and stuff.
Absolutely. My pleasure, Ashwin. My pleasure.
Perfect, sir. Thank you so much for agreeing to do this, sir.
Thank you. Thank you so much.